Welcome to our lecture series in Financial Basics. Today, we will talk about brokerage companies, brokerage accounts, and trading apps. Let's begin. Brokerage companies, accounts, and trading apps are the operational backbone of modern financial markets, connecting investors to exchanges like the NYSE and NASDAQ. A brokerage company acts as a financial intermediary, routing investor orders to exchanges and ensuring settlement and record keeping. These companies generate revenue through various sources, including commissions, interest on margin loans, and asset management fees. Real-life examples include Charles Schwab, known for diversified services, Fidelity Investments for retirement planning, and Robinhood for its mobile-first, commission-free approach. Brokerage firms are categorized by their service levels, from full-service firms offering personalized advice to discount brokers focusing on trade execution. App-based and fintech brokers, like Robinhood, emphasize ease of use and mobile access, often designed for new and younger investors. Many firms now operate hybrid models, combining education, automation, and advisory services to cater to a broader range of investors. A brokerage account is a financial account where investors deposit cash, hold securities, and execute trades, with the firm acting as custodian. These accounts are protected by SIPC insurance against firm failure, though market losses are not covered. Types of brokerage accounts include individual taxable accounts for general investing and retirement accounts like traditional and Roth IRAs. Joint accounts are owned by two or more individuals, while custodial accounts are opened by parents or guardians for minors. Cash accounts allow investors to trade only with deposited funds, offering lower risk and fewer regulatory requirements. Margin accounts, however, allow borrowing funds from the broker using securities as collateral, but are subject to margin calls and forced liquidation. Trading apps serve as the technological interface between investors and brokerage systems, offering features like real-time price quotes and portfolio tracking. However, the ease of trading and behavioral nudges in apps can sometimes encourage overtrading or amplify emotional decisions. When a trade is placed, the brokerage routes it to a stock exchange like NYSE or NASDAQ, a market maker, or an alternative trading system. Common order types include market orders, limit orders, and stop-loss orders, with execution quality and speed being crucial. Brokerage firms operate under strict regulatory oversight from bodies like the SEC and FINRA, with SIPC providing investor protection if a broker fails. These protections are vital for maintaining trust and stability in financial markets, ensuring a secure environment for investors. Thank you for watching our lecture in Financial Basics focusing on brokerage companies, brokerage accounts, and trading apps. See you at the next lecture.